Good morning, everyone, and welcome to today's webinar. I see that we have a bunch of people that are still logging in, so we're going to get started in just a moment. Today, we're going to be talking about rental income calculation for lower DTIs and better rates for property investors. And we'll get started in just a moment. I just want to give everyone a chance to log in. Okay, out of respect for everyone's time, I will go ahead and get started. So today's agenda, first we're going to be talking a little bit about LendSure Mortgage Corp, who we are and what we do. Next, we'll be talking about investor loan income calculation method. We're going to go through a real world loan scenario based on an actual loan. We're going to be discussing different investor cash flow loan products. And finally, we're going to be going through our questions and answers. If questions come up during the webinar, please go ahead and use them in, and go ahead and submit them via the chat, and we will get started. I'm getting a comment on the audio, so if you guys can bear with me just a moment. If you can hear me, please use the chat to say hello. Awesome. Thank you so much. I see a bunch of viewers saying hello. I appreciate that. So I'd like to introduce today's speaker. It's Joe Leiden, the co-founder and managing director of LendSure Mortgage Corp. Take it away, Joe.
Thanks, Rose. This slide really speaks for itself. I'm not going to spend a lot of time with it. Probably the most important thing here is that the management team here at LendSure is the same management team that ran accredited home lenders. We were a publicly traded company that sold to a private equity firm in Texas in 2007. Next slide. Next slide. Rose.
Joe, there's a tiny lag in the system. You should be seeing the About Us slide.
Okay, I think I just spoke to that.
All right, just 1 second. I'm sorry. I'm having a little bit of tech. There we go.
There we go. Okay, so here, I'm not going to read slides to you guys. I figure the people who are looking can read the slides themselves. I'll speak to the important points as I see it, but I usually like to start out in telling people what we don't do, and that is we don't do Fannie Mae, Freddie Mac, FHA, or VA loans. We're solely focused on the non-QM space. Our principal focus is on targeting A-paper borrowers who are just missing Fannie Mae guidelines for one reason or another. And during this presentation, I'm going to describe some of our programs and give you some examples of the borrowers we serve. Next slide. So the stats on this slide clearly indicate a portfolio of loans that very much look like A-paper borrowers. Now, for those of you who've been in the business for some time, I would compare our best products, our super prime products, we call them, to those of the alt-A world in the 90s and in the early 2000s. 65% of the volume we do is like the alt-A business of the early 2000s. They're high-quality borrowers, low LTVs, using alternative documentation approach for the income piece of a given transaction. Next slide. There you go. So since our last webinar, I've spoken directly to the heads of secondary of no less than 7 or 8 large A-paper mortgage banking operations. All these guys are looking to add non-QM products to their menus. They tell me their loan officers are clamoring for these products. So if loan officers want to earn the same money this year that they made last, they will need to be looking at the non-QM products in order to do that. In this webinar, we're going to do a deeper dive and discuss just our investor products. Next slide. So unlike Fannie Mae, we do not have a cap on the number of investment properties financed by one borrower. Fannie Mae's limit is 10. At LendSure, we will allow up to 10 loans to the same borrower. So for that borrower who has 30 properties, 15 of which are financed and 15 free and clear, we will do cash out loans on 10 of the free and clear properties. We also use a unique approach to calculating DTIs for loans with rental income/losses. And I'm going to walk you through some examples of that in a few moments. We'll do DTIs to 50%, and non-warrantable condos are permitted. Full doc programs are available, bank statement programs are available, and DSCR or stated income programs are available on investment properties as well. Next slide. So when I'm asked by a broker to give me an example of a loan that just misses Fannie Mae, I think of the way we calculate the DTI when we have a loan with rental losses. We do it very differently than all of our competitors, so listen closely. All of you know that if a borrower has rental properties that are producing a loss, that this loss is treated as a debt in calculating the DTI. This can often have a significant impact on the loan's DTI. I'm going to walk you through an example next. Next slide. So this is actually it's a real loan that we did, but this fellow was wanting to purchase a condominium for $440,000, putting down $123,000, giving us a loan to value of 72%. The borrower was very much a paper. His FICO was 790 and hers was 777, and it came in as a Fannie Mae fallout transaction. The full doc income was according to Fannie Mae guidelines, with the exception of the treatment of the losses from the rental properties. Next slide. So here's the schedule of REO. The top portion of that schedule shows you the 8 or 9 properties that the borrower owned. And you can see over towards the right-hand side of that, there's a column that's defined as Schedule E, gain or loss. And it provides the total down there at the bottom of $66,211 loss. And you can see right next to that, there's depreciation. We add that to the Schedule E, gain or loss. And then we have a total line after you add those two together of $28,000. And then finally, your far right-hand column shows that divided by 12, giving you a monthly loss of $2,348. This guy was buying a new property, and it too was going to be a non-owner transaction. So we used the net rental method to calculate what the gain or loss is going to be from that property. As you can see, it is going to be an $1,196 loss based on the details of the loan. So you add those two together, basically these folks have a loss on their rental portfolio of $3,544 per month. Next slide. So here's a look at these folks' income situation. The fellow worked for a long time, 20-year job, making $6,500 a month. He also had a second job for 5+ years, making another $700. And his wife, I think she was an RN, making $6,000 a month. So all of that was full doc, W-2s, 1040s. However, the rental income loss shows up there because we adjust income. We don't, Fannie Mae would take those two negatives, the 2,300 and the 1196, and they would add those two together and they put it down as debt. And I'm going to show you the impact, but we don't do that. We offset income. So you see here us offsetting income. The first 6,500 plus the 700, 6,000, you're getting to about 13,000 bucks. Then you reduce that by the 3,400 and you get to 9,700. Next slide. And so when you do that, the debt payments, as you can see there, the mortgage payment on the owner occ was there. The guy had some credit cards. can see that the negatives that Fannie Mae would put down there as debts, the $2,300 and $1,100, makes their total debts $6,448. So this guy then came out to be a 48% DTI, and that blew the deal, and it meant that this deal wasn't going to get done by Fannie Mae. So the broker comes in our direction, and because we add it to adjust income and don't use it as debts, you can see the change in DTI. So for us, we saw it as a 30% DTI, and we're able to close the loan. Next slide. So in my mind, that when as I said earlier, when I answer that question of the broker, give me an example of what we do differently, that's at the top of the list, because that's a very powerful one. We do a lot of transactions, and these are transactions that are on owner-occupied properties as well, whereby the borrower has a rental portfolio, even if it's just one or two houses, in addition to their owner-occ, and that the negative that they might be carrying impacts their DTI. But because of the way we approach the use of the negative rental losses against income, we're able to do more loans. So this is in my mind, one of a number of examples of what it is that we do for A-paper type borrowers that are just missing Fannie and Freddie guidelines. So we've got several programs. We do full doc programs. We do 12-month bank statement programs and 24-month bank statement programs. We can do investor loans up to $2 million, and they're fairly competitively priced. Next slide. We also do what we call a DSCR program. These are borrowers who want us to lend money using the property's cash flow on the principally. So, you know, the DSCR is debt service coverage ratio. So we're not focused necessarily on the borrower's income. We're not calculating a debt to income when we do this loan. We're principally focused on what is the rent on that property and what is our PITI. And based on where we come out on that, whether it be above 100%, meaning it totally cash flows, there wouldn't be an adjustment to the interest rate. If the DSCR were a little lower, say between 80 and 99, there would be a 25 basis point adder. And then if it were lower than 80, there'd be a 50 basis point adder. So these are the very popular products with you know, experienced professional investors. Most of these folks don't, because they have lots of losses on their tax returns, they don't qualify on a full doc basis. And because of the ease of doing these loans, they seek these products out. We do a fair amount of these kinds of loans. We do have a first-time investor program, but it's for purchase money only, and the maximum LTV on that product is 65%. Next slide, please. So this slide here, we're looking at comparing, you know, conforming, call it Fannie, to LendSure. I mentioned earlier that Fannie Mae, the maximum financed properties is 10. We're unlimited. We do business with investors that have 30, 40, 50 properties regularly. Minimum FICO on Fannie is 720. We'll go down to it says we go down to 500. Most of the loans that we do have actually good FICOs, but we do have a minimum score of 500. And sometimes we'll see investors that actually have good loan values and have FICOs in the 500s, but most of them are in the mid to high 600, and frankly, most of them are in the 700s. But I think the point is we'll do them in the 600s. Documentation, Fannie's full doc or Schedule E on tax returns. We'll do it, either full doc. We have 12-month bank statement program. We've got a 24-month bank statement program. And we have the stated income or the cash flow, the DSCR program. 2 to 4 units will go up to 80. They're at 70, 75. Non-warrantable condo, we will do those under the DSCR program and the bank statement programs. And we will allow the loan to be closed in an LLC if the broker wants to do that. Next slide, please. So what makes LendSure different? I think probably most importantly, we do pre-qualifications, loan pre-quals on all loans by experienced in-house underwriters, usually within 24 hours. When you ultimately submit the loan for approval to the underwriting group, those usually get done in a couple of days. Very good funding times. We do have an ability to close loans in 7 to 10 days. So for those loans that fall out of Fannie Mae at the last minute, and they're full packs that people bring to us, we can get those things closed in 7 days. We did 4 or 5 of those last month. We do make exceptions. We see this non-QM space as an environment where every loan's got a story to it, so we're willing to listen to the story. So we make common sense loans. We think we've got a very, very good bank statement program for self-employed borrowers. It represents about 50 to 60% of all of the loans that we do. And we will provide you with a service to do the bank statement analysis up front without you submitting a full package. So if you send us a 1003 in a bureau with the bank statements, usually within 24 hours, we'll get back to you with call it a pre-underwrite, a good look at here's how we see the income, and here's probably how this loan's going to be priced. It's kind of a back and forth with the broker. And I mentioned earlier in this presentation that our approach to calculating the DTI when having rental losses is very aggressive and can enable you to get more loans closed. And next slide.
Oh, sorry.
And so, yeah, that's it. That was the next slide. So, Rose, next slide, please. That. So with that, I'm happy to take your questions and try to provide some answers for you.
Okay, Joe, we've had several questions come in. Several people are asking whether they're going to be getting the slides from this presentation, and the answer is yes. I will be sending that out to everyone shortly after the presentation. I got a few questions on what would be a down payment and what would be the rate for various credit scores. Do you want to talk about requirements for credit scores and down payments?
I can. I mean, that would be a little all over the place, but let me give you some examples. In the DSCR program, we call that LendSure's expanded investor product. We do those loans up to 80%, though the 75 to 80 bucket are purchase money only. So obviously you'd need a 20% cash down payment on that kind of a transaction. And so anything below that. So, we do the to 80% with FICOs north of 700. And we go to 75% with FICOs north of 640 and the like. So generally the DSCR programs are targeting borrowers with better credits. We will go down to 620, but the 620 requires a maximum LTV of 65. So you'd have to put 35% cash down on that kind of a property. The LTVs are similar in the expanded approval areas where we would do them with full doc income documentation and bank statements. The difference between the expanded programs and the expanded investor programs, the DSCR program, is pricing. So if someone brings us more, documentation on the pricing front, whether that be full doc or bank statements, the pricing could be anywhere from 50 to 75 basis points lower.
Okay, great. And I have a question. Do you have borrower paid and lender paid comp plans?
Yes,
or
we
comp
do.
Options? Good.
And of course, the lender paid program would be, you know, tied to each lender or each broker. Each broker is going to have a different program. So we offer both of those programs on all of our products and to all of our customers.
Joe, I got a couple of different questions on whether a loan officer can do business with us individually or whether his firm needs to be approved with LendSure in order to do business.
We do need to have the firm approved with the company. So we can't do loans with a loan officer that isn't attached to an approved broker.
Okay, great. And does the investor have to be seasoned?
Well, we do, as I mentioned, we do have a first-time investor product. It's for purchase money loans only, and it's to a maximum of 65%. So that would suggest that that investor doesn't have to be experienced. We do some of those loans. We don't see too many of them, but probably a couple of months come to us in that regard. The DSCR program, probably the one thing that we're most sensitive to on that is there are some brokers who try to submit a loan suggesting that the property is going to be an investor property, but perhaps it's not. It is going to be, the broker's trying to get a deal done on an owner-occupied basis using basically stated income. And we're very sensitive to that because we cannot be effectively breaking the law. These DSCR loans are only legal on investment properties.
Okay. And do you lend to commercial businesses? Do you do term loans for business owners?
Well, we make loans to people who own companies, self-employed individuals. So the answer to that is yes. We can close a loan in the name of an LLC or in the name of a corporation. So the answer to that is yes. Your question is a little confusing to me, but I've tried to answer it the best I can based on what was asked.
Okay. And is a California licensed LO able to be compensated if we submit an out-of-state transaction to your corporate team through our local rep?
As long as the local, whoever is on the 1003 in terms of a loan officer is licensed in the state where the loan is being done, we will be good to go. So that's what we'll be looking at. Is the loan officer licensed in that state to do loans? Is the broker licensed in that state to do loans? The answers to both of those questions are yes, we will be able to do the loan.
Okay. And how do I quickly obtain accurate rates, fees, and guidelines for these products?
Well, two things. You could provide us with your contact information, and Rose can send you some information directly after this meeting, most likely, we would take your name and contact information and assign you to one of our account executives, and we'd probably have a salesperson call you, introduce themselves, walk you through our products, and send you whatever information you need to start doing business.
Okay, great. And I think that is all of the questions that we have. If you have any other questions, please go ahead and type it in the chat bar. And if you come up with questions later, just simply respond to my email address and I will be happy to answer them individually. Okay. I'm not seeing any additional questions come in. There's a couple of others very specific about specific scenarios, so I'll be addressing those separately. It says here one last question, Joe, and then we'll close it out. Can you close a loan as a sole proprietor?
Yes, of course, most borrowers who are self-employed are sole proprietors. They come to us, and if they want to do business on a full doc basis, they're giving us their tax returns. If they want to do it on a bank statement basis, they can do it that way. Or if they want to do it as a DSCR, and that is based on the cash flow of the property, they can do it that way as well. In terms of a sole proprietor, that just, to me, that means that you're asking if the borrower can put the loan in his own name, and the answer is yes to that. If I missed that question, I'd ask you to enhance the question so that I can better understand it.
Okay, great. All right, well, that is it for today. Thank you, everyone, for joining us on today's webinar. Shortly, I'll be sending out the slides to the webinar, and I'll also include a recording. Thank you, everyone, for joining us today.
Thanks very much for attending the webinar. Thanks.
All right.